commissioners transcript for this meeting of September. Is there a motion?
I'll make a motion to approve.
Is there a second?
I second.
Okay, motion has been made and properly seconded. All in favor, say aye.
Aye. Aye.
Thank you very much.
Aye.
Thank you. The next item on the agenda is the October-November 2023 investment performance report. Alex, I turn that over to you. Oh, forgive me, Christopher. You always
No, you're
keep it
good.
up, so let me come to you first.
No, you're good, Donnie. You can pass it over to Floyd and Alex to go through the numbers. Thanks.
Yep.
Thank you.
So, very briefly, September, October, and into November was a bit of a, blip in the recovery in the markets that we've seen in 2023. Following the Fed comments in September, the speech out of Jackson Hole, interest rates, shot up pretty quickly, impacting, fixed income markets certainly, but also the expectation of higher rates weighing on the markets, impacted equities as well. So, Floyd, I don't know if you want to provide a little more, just some brief detail on the last 2 months, and including November, I guess. Obviously, as things that this ship is righted here in November, and then we can talk about performance.
Floyd, we can't hear you.
You there, Floyd? All right.
Hey, here I am. Sorry about that,
Okay.
Alex. I was on mute. Thank you, Don, for pointing it out. I was on mute. So during the month of September, you saw Treasury yields. They actually jumped up a little bit off of a couple concerns that ended up pushing the price for Treasuries down, which created a lot of turmoil within that month. You also saw during the month of September oil increase. So energy did very well during that September rally for energy. And one thing to point out is that, while it's not on here, but if you look at the time frame from the end of July to the end of September, there was a big dispersion within performance for sectors. For example, energy domestically returned essentially about 12%, while IT, which is the dominant portion for the S&P 5 index, Russell 1000 index, Russell 3000 indexes, that had a return of negative 5%. So you saw a very big diversion within sectors. That was because of the spike in oil coming in September. It ran up. Energy companies started to do a lot better. That's what happened. You saw that carry over internationally, also with energy for that third quarter, that calendar year third quarter, had a return of positive 8%. IT, which a lot of managers, especially active managers within the international space, they're usually going to have a slight overweight to IT. IT was negative 8%, so that dispersion was seen during that time frame. Now, what's interesting is that you have October, which was definitely a down month, but then all of a sudden November it roars back. But even with the roaring back, there's some things that again, we always talk about what's the detail behind just a pure numbers. When you're looking at it from a pure number standpoint, you'll say, okay, hey, November, you're up 8+%. It's actually probably going to go down as the best month in the past 12 months. Why? You had inflation have a bigger bump down than expected. You also had companies still hitting their numbers. Now the caveat, and Fran, I think you definitely remember this one. The caveat is not so much everybody's hitting their numbers and expectations, but really more of what does the top line look like. And the top line, if you're going by what FactSet just reported a couple of days ago, is that there's less and less companies hitting the top line for the third quarter. About 17% to 20% of S&P 500 companies that announced earnings actually hit their top line number. So that top line estimates and numbers. So that lets you know that what's going on to hit their numbers is because people are starting to do changes within either spending less. And when I say people, this is businesses. Businesses are changing the way that they do business, either extending the their payment periods, or they're spending less, or there's been some small layoffs here and there. in order to quote unquote hit those numbers. So that lets you know that the slowing within the economy that the Fed wants to see, that they're seeing it. Yes, October's been a good month, but even with that, even with the good month and the good numbers, because also energy has definitely come back to earth and really more, that would be oil. The what other point to note is the fact that the Magnificent Seven that have essentially been the wind beneath our wings for all of 2023 kicked up during the month, and even if you looked at the performance for for essentially year to date, a majority of the performance within domestic equities is going to be it's going to be because of Apple, Microsoft, Amazon, Alphabet. You have Tesla, Nvidia, and Meta. That's what's really pushed the market. As a whole, if you look at the S&P 5 equal weighted, that's not even 3% for the year.
From an economic standpoint, Floyd, I mean, I think retail sales were a little better than expected in September. Worse than expected. In October, or excuse me, better than expected in October, but still a slump. I think we saw maybe a strong early indications on Black Friday. I think the consumer has been a little more resilient than people have expected this year. At the same time, I think I've noticed. Auto defaults are up, consumer debt levels are up. And I think we'll probably get into this when we talk about our rebalance, but I think you mentioned earnings, where do we see the consumer going? How much of that is reliant upon, I don't even know, fiscal policy or continued, amelioration maybe by the Fed?
Yeah, no, you from that standpoint, if you're looking at just what just recently came out about consumer spending, it rose 0.02% in October, which is down essentially from September 0.7%. And even what you're thinking about when you're noticing people's spending habits, they're choosing where they're spending. So even if somebody's hopping on a plane and going somewhere, for instance, they're going to Vegas, they're not gambling in the casinos. So people are really starting to pick and choose where they're starting to spend. You are seeing it slow. That change of the change. So not just consumer spending change month over month, but the change of that over a consistent basis has definitely started to slow down. And if you're thinking about it from a pure numbers standpoint, inflation is still there. Wages, while they did bump up, they haven't bumped up enough in order to quote unquote neutralize the inflation. So because they haven't bumped up enough to neutralize inflation, you start to already see that eating away at savings within just your median income. As you pointed out, Alex, you already start to see the rise in consumer balances on credit cards, starting to see the rise in auto defaults. You're starting to see a rise in delinquencies across the board. Now, it's not a big rise, but it is ticking up. And I think that is just one of the signals that says, you know, this is, we've gotten enough out of the market. Consumers have given enough. But, if you're looking at it for 2024, it doesn't look like businesses are looking to spend any more than they have to. And for the government, they're having a problem just getting their usual fiscal budgets neutral, budgets passed. So, the government's going to be less pressed to spend in 2024. So if you're thinking about GDP as a whole, if consumers aren't going to be spending as much as, they're not going to be going out and trying to spend even more than they did in 2023. Their governments is not going to be spending a ton because it is going to be an election year. People want to make sure that they're not, spending aggressively, and businesses aren't going to spend a lot. That means, it's already supposed to be a slowdown in GDP that was forecasted throughout the world. That's definitely going to be here, and that's definitely going to be a drag on equity returns that you saw essentially bounce back from the lows of 2022.
Yeah, and I know we're going to talk a lot more about a lot of that stuff when we get into the rebalancing proposal, but no, thanks, Floyd. I don't know if there are any other questions or discussion topics before we get into the performance of the plan through October.
Yeah, I have a question. I have been observing the advances that we've been making to Ukraine, And I know we're considering additional dollars for Ukraine and Israel. Now, my question is, if there's a budget in place, how is the country able to fund all of those advances without breaking the budget? I mean, do they do it outside of the, how does that work?
So, they do it within some of the bills that they pass. So that's where it'll be earmarked in certain places to what you're pointing out, especially when it comes down to certain bills that they'll pay. They'll say, okay, hey, this is an education bill, but they don't have earmarked like, hey, X amount will end up going to Ukraine or Y amount will end up going to, Israel. We're still doing that. So we're doing it actually through so Israel's example, you're doing it through defense spending. So with defense spending, what they're doing is, they're essentially saying, okay, well, we'll pay for the ammunitions. So it's not, so we can pay for ammunitions. We have it in a stockpile. We can give it to, Israel. And it's not, it is not a pure cash. It's not, we're not giving out cash. We're giving out something else. Now we have to pay for those ammunitions to restock that stockpile. But we don't have to do that today. So they're doing a lot of borrowing behind the scenes. They're actually doing a lot of trading in order to get that done. There probably are some off balance sheet transactions that they're doing that they don't have to get past. There are some executive orders that they can do in order to get things done. So that's how they're able to get it done. Now, again, like somebody has to pay for it, and it ends up being, everybody on this, everybody on this WebEx.
I mean, it's an interesting question, Don, and I think, we have a Speaker of the House, we have a temporary funding initiative in place. That's going to come up again in February, I think, or something. I mean, I assume that the nature of, it's, like I said, it's a very interesting question, one I hadn't really thought about, but the nature of replenishing those stocks, I imagine, is going to be a big component of that, that funding discussion. We've already seen, it come to a political head with, different groups wanting to separate the two, conflicts. I mean, geopolitical risks are a major headwind, and not just the two wars. It's it was the brinksmanship we're seeing at home. So, and as Floyd mentioned, it's an election year too. So, yeah, I don't know if was that helpful.
Yeah,
helped a little bit. Yeah.
But all of that hardware that we're shipping abroad, as you just said, that's going to have to be replaced, and I would assume that's going to have a positive impact on the economy. Just off the top of my head, but we'll see what happens.
We'll see what happens. But I mean, again, they don't have to replace it today. So it's one of those things where they don't have to replace it today, unless they feel that we're going to, quote unquote, we're going to war tomorrow. But they do know that they're like, okay, we can do that. We'll have to do it soon. I mean, it's the same thing with, honestly, the oil reserves. Our oil reserves are significantly lower than they should be, and that's something that has to be replaced too. But it's they're going to try to be as strategic as possible with doing that spending and increasing the oil reserves when they can.
Don, just if I could add, there in FY23, I think there was over $60 billion allocated to the federal budget for foreign aid. And foreign aid is a broad category, as Floyd was pointing out. So that aid could be used for crises around the world that pop up. That money is allocated. I don't think it's exceeding any budgetary mandates. So it's given the United States position, I think that money is always in the budget for ensuring to the best we can stability in the world. So,
thank you, appreciate it.
Leaf, did I see you have a question too, or?
Yes, please. One part quick on just, one of the things the Biden administration did yesterday was put out excuse me, something about how purchasing weapons and equipment for Ukraine helps individual states. So there is like a component of manufacturing with that they're trying to make as a political point on. I want to go back to some of the projections that you were talking about for next year. We're starting to see a lot of banks and investment firms put out their forecasts for next year, and a lot of them really are around, they're anticipating, actually growing equity markets and declining interest rates here. And I just curious because that was a little bit contrary to what you were just talking about on that in the original discussion about declining GDPs and things like that, as we're starting to look at what could possibly be actual tailwinds to an economy that's over 5% growth at this point.
Yeah, I
So,
mean, it's we saw I think the revised GDP came out for the third quarter, and it was at 4.9 to 5.2. Certainly not recession territory, pretty high. I mean, we've seen some slowing, across the board. One of the concerns that we've seen is slowing in particular in services sectors. So that, the areas that had been, wrecked by COVID, that had been growing extremely strong since COVID, really driving the economy, they led the economic slowdown in October. So that's one thing we're looking at. And in relation, I watched a lot of the videos yesterday that came out. I think we're in line. Maybe I'll let Floyd get into this a little bit later, but I think, what I saw was a lot of, maybe we're expecting a mild recession in the first half of the year, which prompts rate hikes in June, in the middle of the year, which drives markets by the end of the year to new highs. I don't think that's, certainly not out of bounds. But when we look at, again, where we've, where the economy is, today, the last month and a half of actual data we've seen, and, maybe a little bit uncertainty in the next 2-3 months, if things play out as, we expect, as most of these other economists expect, I think that, portends pretty well for equities on the back end. But like I said, in the near term, there's a lot of different ways things could go for that to play out. I mean, there may be no, recession, in which case the Fed, there's a higher for even longer rate hike scenario. Inflation could, persist, despite the, it's been reined in, as we've said, but there's still, volatile pockets, food, energy. So yeah, I don't know if you have anything to add on that, Floyd, or.
so Leaf, I go back to the beginning of this year, and most of them were forecasting recession for this year. So so I look at that and say most of them forecast recession. You have a soft landing. You look at the data behind what they were forecasting recession, and you significantly low unemployment. You still had, a lot of money on the sideline that was available, available. You still had a lot of people, so, a lot of businesses, governments trying to find people to get to work, to work. So it was a very big disconnect in regards to what creates a recession, because inverted yield curve, you're going to have a recession. So you have to look at all the other factors, but beyond that, I would probably say, as more people have said, okay, well, you're in this soft landing camp, to me, that lets me know something else is being missed. And if something else is being missed, then let's start looking at all these little individual pieces. And if that, okay, well, everything depends on what's going on with the median consumer. And if I think the consumer is stretched, and I also know that over, while we talk about inflation, we talk about the numbers, everything else, I'm going to just bring at a real simplistic level. If the consumer makes up 70% of GDP, and I know that groceries for the past 3 years have risen 25%, you can avoid that cost. You can avoid the cost of a new home. You can avoid the cost of a new car. You can avoid the cost of a used car. You can avoid so many other costs because you don't have to do it. But that's a cost you cannot avoid. And so between that, seeing people actually become a lot a lot more stringent on what they spend, how they spend, and where they spend it, lets me know that, okay, well, yeah, next year will probably be good, but if it's good, it's going to be based off of, okay, I'm going to, as a company, find ways to save money, to have better earnings, which are going to push the stock market higher. Growth isn't going to collapse, so that's going to be good. But also at the same point in time, I think the one thing that gets sometimes lost is that when you'll see it with RCMAs when they come out. It was very interesting that I want to say earlier this month, one in Financial Times, BlackRock was coming out saying, hey, you know what? We can see the 10-year treasury have a yield of 5.5% for the next 10 years. So, I think, like, one of those things where you're like, okay, this, yeah, higher for longer, definitely, because what they're the Fed saying, hey, you could probably see 2 Fed cuts in the second half. The equities markets like, well, we want to get everything out and done, and then we can go on to the next thing. That's just how the equities market really wants to operate. But okay, yes, you could definitely see it. All right, I can see the rates being higher, but then the reasonings for it to go lower. Okay, well, who's to say inflation is going to just subside? If I know the main components, which are shelter, uh, shelter isn't really deflationary. I don't know about anybody else, but I don't know how many landlords say, hey, I want to allow you to pay less rent, when I know that, you are, if I'm a city, and especially the city of Philadelphia, and I know that at a pure taxation standpoint, that the houses have at least increased 10 to 15%, that I need to increase my revenue. So it's one of those things to where when you start to think of all the underlying things that push it, you're like, all right, I can see squeezes over here. I can see squeezes over there. Yes, it might be positive, even if it's a good equity market might be 5% next year. But again, if I can get, if BlackRock is right and I can get 5.5% on bond, 5.5% on bonds, or a 5% yield on a 10-year, that's where we're at.
Yeah. Okay. No, I appreciate that, and I absolutely agree. Right. I mean, everybody had predictions of doom last year, and it it didn't happen. So take
Right.
those with all the salt lick kind of a thing. But yeah, thank you very much. I appreciate that.
No, and yeah, and again, it's the components aspect, and I think that's the one thing. And I try to talk about on the call is all the other components, because I think that what builds up into the numbers. And I think we can all walk around and see, like, whether things are super duper vibrant or if they're just okay. And it seems like they're okay. They're not super vibrant.
And we're going to cover, I mean, I think this discussion really kind of blends into the rebalance recommendation. So I can go through the performance briefly here, and then we can move on to that. So on the screen, this is as of 10/31/23. You can see the top line, $555,351,046 as of the end of the month. 1 month return down 2.87, 30 bips behind the benchmark net of fees. For the 3 months, August, September, October, kind of most of the market decline that we had talked about earlier. The plan slightly lagged the benchmark, and again, largely that was on the plan has been overweight to equities. It is the reason why, on a year-to-date basis, the plan is outperforming quite nicely. But again, certainly that will be a reason for underperformance in a down quarter. For the most part, active management has done quite well over that period to offset the decline in equities. So we can go through both over the quarter, generally on a year-to-date basis, and for the month as well. Within domestic, PineBridge was slightly behind for the month, ahead for the quarter, ahead year to date, close into the benchmark, but generally doing the job that it's in there for. On the small cap side, Copeland also continues to deliver pretty well. A little bit closer in the month, quite strong performance on a year-to-date basis. You can see in positive territory, where R2000 is down well into negatives. Something nice we've seen, more recently, this S&P 600 has begun to exceed its, Russell 2000 counterpart, higher quality. Something we again expect in a downturn for small caps. So over the quarter, I think the Russell 2000 is down 16.7%. The S&P 600 all positive earning, down just 15%. So again, that in a whole, and when you can look at the total, the total blue bar for each section, obviously this doesn't include any overweights or underweights between equity and fixed. So it really lets you see the, pure impact of active management or those types of decisions. And, both, large cap, small, international as well, a little tighter for the month on international equity, but, again, year to date delivering, pretty strong outperformance in both Acadian and Earnest, kind of, protecting for the on the downside for the quarter. Next page, moving on to fixed income. So active management, again, on a year-to-date basis, certainly the spread sector is helping. Active management, generally contributing. A bit of a mixed bag. But someone wrote in the thanks, Floyd. Again, active management here a little bit less so. I think total fixed income down 1.54. Barclays aggregate down 1.58 for the month. On a year-to-date basis, down 1.75 versus down 2.77. So again, like I said, the addition of spread sectors, both Sky Harbor and MetLife investment grade credit, beneficial. Garcia and Barksdale have lagged, certainly, when rates jumped in September and October, I think both of these managers have been positioned for a plateau or a drop in rates. I think, given the Fed rhetoric, following data, they're both positioned for, no further rate cuts. And, when, again, rates unexpectedly jumped, I guess, in October, that certainly impacted them both. I don't have a number, but I did speak with our analyst, yesterday. Garcia Hamilton has, been very strong in November. I think, Chris, you and I had spoken previously, they have sort of a history of, in time, they make, some broad interest rate calls. It comes from the top. They have been on a watch list as their chairman. Gil Garcia ran for mayor. He didn't win. He's back in the shop full time. But he kind of put this call on perhaps a little early. But indications we've seen through November are that it's come back and paid off, and we would expect the same for Barksdale. So again, pretty strong, returns on a year-to-date basis. The plan, like I said, again, is up 4.30 net of fees. Nearly 1% ahead of its benchmark, even after giving a little bit up here in the last couple months. Questions on any of that before we move on? Hello?
Yeah, Alex, we're still here.
All right, I may have gotten disconnected there for a second. Sorry. Yeah, any questions before we go on to discuss maybe rebalancing?
It was no questions.
All right. Well, in that case, I mean, at a high level, the asset, you can see here the benchmark, 45 domestic equity. I think, what was it, 25, 35 fixed income. Again, we went through a lot of the data points that are giving us, some pause. And I think going forward in the, near to intermediate term, we think it's prudent to adopt a neutral positioning. So that's certainly not defensive, but it's not, overly risk-seeking, which I think, the plan has built up to a pretty steady, overweight, to equities as a whole. I think, at the time, currently about a 6.5% overweight to stocks. Just getting all these beeps. So we propose really a simple rebalance, getting back to targets, and really waiting for some of the economic data that we discussed earlier, and seeing where that comes into play. So excuse me, I'm not able to see anything on the screen right now. I'm having some really issues with my
Hey,
computer.
hey, Alex, it's showing you the portfolio recommendation.
All right. Sorry, I don't know if. Okay, here we go. Yeah. So I mean, I don't know if you had a chance to read this, but again, it's kind of speaks to a lot of the themes we had spoken to earlier. We did provide some data. I don't know, Bill, if you want to bring up the PowerPoint that we had sent. And I think, again, the general theme is, sort of uncertainty. Let's take a look at corporate earnings for the fourth quarter. Let's take a look at consumer figures as they come in from the holiday period. The economic slowdown that we're talking about. I mentioned, like I said, some of the PowerPoint charts reflect PMI figures. And what you'll see is a steeper increase more recently, or steeper decrease in the services PMI. I think it also, we had some data on the consumer debt levels. But Floyd, I don't know if you want to, mention any, and Floyd and I, as we've discussed it, I think he mentioned it sort of earlier too. We've seen more and more parties enter this soft landing or no landing camp, and it's given us a little bit, like I said, a little bit of pause. This is what the trades will actually look like. Certainly most of the overweight is in domestic equity, slight overweight small caps, slight overweight in international, and that'll be redeployed. Generally across the board, not into the credit sectors. They're already, overweighted. If we're pulling back from equity risk, we feel it's, consistent not to add to that risk on the fixed income side. But, no qualms adding to Garcia, Barksdale, or MetLife. Again, we've seen recent recovery in Garcia. We expect the same in Barksdale. We'd like to keep it diversified across the active fixed.
Alex, I did have a question concerning the reallocation money, not necessarily reducing the equity portion, because I think aside from the macroeconomic call that your memo makes, I would say that, to me, a more important justification is the funding level of this plan versus, for example, the municipal plan, the assumed rate of return having been lowered over the last several years of this plan. I think it invites less risk. So I think that's to me, a compelling reason to be more neutral. Although I certainly respect your macroeconomic outlook on this. My question concerning Garcia is that the recommendation is to put roughly 47% of that 38 million into Garcia. And I hear what you said about November, that they had a good November. But if you do look at their numbers over the last 3 years, they're not particularly impressive. And I would have asked this when we were reviewing the performance allocation, but I wanted to wait until we talked about this issue. So are you indicated that Garcia may have been a little premature in their positioning for interest rates. And I get that, but isn't that in itself a market timing call? And I get that we want active managers to do that, but if they were so incorrect about the timing of this call, leading up to November? Do we have any concerns going forward in allocating almost 50% of the 38 million to them?
Hey, I'll
Um,
answer that, Alex.
yeah, go
I'll
ahead.
answer that. So Fran, I mean, you're right. Like they played defense earlier than everybody else. So while a lot of you're looking at Barksdale, when you're looking at MetLife, they still carry a fair amount of credit exposure. Garcia Hamilton said, what we're seeing, where we know that it's we're seeing we're not seeing really a good environment going forward. They just projected out like, okay, we don't see that. We want to be super safe. We want to go more into treasuries. We want to go more into mortgage backs that are at a lower rate, that actually the prepayments won't be there, and will have a lower default rate. So that's where they went. Now they went before everything else, and credit has been what people have focused on, especially from last year even into this year. And even if you looked at it from a pure risk return standpoint, high yield has been the best performing sector for fixed income for this year. Now, if you're looking at their portfolio now and thinking about going forward and you want to be more conservative, they're positioned conservative. Now, we think that they kind of could have waited to make the move, but they decided to make that move a little bit earlier. I know as definitely as if rates start to come down and they start to come down, the treasuries will definitely benefit and the mortgages would benefit. In some respects, if you're being a contrarian value type of investor, their prices are still low. So their prices are low. They'll be able to increase if and when rates increase. So that's a positive for this portfolio.
Yeah, the one thing that was mentioned was that MetLife and Barksdale are more credit centered or credit focused. I think you said that, but really my question is, it, do we have enough options in fixed income, or do we feel like because we don't want to go into credit with the other ones that the only alternative we really have is Garcia? And that's a question. I don't know if that's right or not, but would it make sense to have an additional option in the fixed income?
So in addition to the, I don't want to say, partial avoidance or just wanting to underweight credit with this move, Garcia is, a shorter duration on the intermediate side. The plan is, we discussed amongst ourselves, we wanted to add a little, relatively more to intermediate. You'll notice Lazard is not there. They were terminated. Chris, that was due to, restrictions and the inability to meet all of the city and the sinking funds exclusionary guidelines. Correct? Yeah.
In part, yeah. I think I'd have to go back and look. It was a while ago. There may have been some performance and other issues,
And there
but
was,
that's
right.
definitely part of it.
Yeah, I'm not questioning why Lazard was terminated. I'm not questioning what moves were made in the past. My question is simply, would it make sense to have a fixed income index product in here somewhere as a catch-all in order to have a parking space when you're reallocating? It doesn't have to be an index. I mean, it could be an active manager. I just throw index out there because of the prices. Does that even make sense? That's really what I'm getting at.
Yeah, I mean that's an interesting question.
I, I'll
Go ahead.
I'll take a stab at that. So you definitely want to get closer to uh, i- if I were looking at this, I know I'll get the price appreciation within Garcia Hamilton. They're a little bit lower duration, they're more intermediate versus long term. With your ag bond index, you would get the similar exposures, especially because the ag bond index, to your point, and Fran, that's definitely a great point, would be, I would say, you'd have a lot of governments and mortgage backs within there, still some credits in there, a little bit of structure, not a ton, and ABS. It's you could do that. I don't think that's bad. I think that would increase the duration of your portfolio. Um, you know, I don't I don't see either one as being a bad thing to do.
Yeah, and it
Is
doesn't
that
have
to
to be
say?
answered. It
Right.
doesn't have to be answered definitively now, by the way. I wanted to throw that out there. Maybe Alex Floyd can,
Yeah,
coordinate with Chris to see if that makes sense
yeah. I mean,
for
and
longer term going forward. That's all.
we'll talk with our fixed income team internally. I mean, when I discussed this with them, we have 38 million to reallocate. We didn't feel like there was any shortcomings in this, you know, right now. We felt that we had the right options for us to put that 38 million. And again, I think the overweight to Garcia, is explained through, credit is also, wanting to allocate a little more to intermediate. But yeah, I'll take that idea back and yeah.
Yeah, and if an alternative investment is not the good idea or helpful, then that's fine. But I wanted it made me think of that when we were talking about the other two just being, credit and having exposure to credit. Was that our only alternative? And the other question I had was on the equities where, and I will rely on both of your expertise on this, but I think the small cap in general and international equity are better value propositions, at least now and possibly going forward, than the large cap. So I'm wondering. Um, I guess that's why we're doing 25 million from the large cap and only 13 million from the small cap, or are we even looking at valuations here, or just looking at percentage of portfolio allocation?
I think it's relative to what the total bet plan benchmark is. Again, the idea behind this is a neutral move, Fran, right? Not wanting to, you know, really take too much active risk on one side or the other of the benchmark. And so, given the weightings of, the small cap within the Russell 3000, given, the benchmark weighting to the ACWX US, it's more of a move to try to replicate that benchmark, replicate, the tar. I don't think we get down granular in the IPS into small cap, for example.
Right.
But it's designed to, like I said, have any large allocation swings have more minimal effect on the portfolio. For example, right, the last 3 months. Now, certainly the plan has recovered here in November, but again, over the near to intermediate term, to minimize the big asset class swings on the portfolio. As we continue to observe the data that comes in, and then
Yeah.
look to maybe reallocate where risk is cheap in the future, right?
And how close will this get us to our target asset allocation?
This is basically, you can see, I think the far right column on this is uh, the updated allocation. So it's basically spot on.
Okay, good, good. And
65,
yeah,
25, slight underweight to fixed income. Oh, I guess I can't. We have a cash target? I think we have an informal cash target. The benchmark does not have cash in it, but for this purpose, we sort of always like to have about 2%, on hand. I think we have roughly about that now. We did raise cash from equities a few weeks ago. We're not including any additional cash raise at this point. Chris will continue to go on, a month-to-month basis. We'll make recommendations to maybe raise 3 or 4 as conditions warrant, or only raise a month at a time, or not raise any this month and continue to draw from cash. So yeah, this really is a move to get back as close to kind of true neutral as we can.
I think that's a great idea. Yeah, and as I said, for reasons additional to the macro analysis, I think that they're good reasons. One other question I had, just general overlying question, Floyd, based on something you said earlier concerning fixed income. All of the articles that we've read, I'm going to say over the last year plus, about the death of the 60/40 portfolio. Has that obituary been premature, in your opinion?
Actually, thank you, Fran, for pointing that out. I wrote about that for us last November. It was super duper premature. I think the The one caveat behind it is about how people think about the 60/40 and execute it. Now, this is within your portfolio, and I want to highlight this. Most people, when they think about executing a 60/40, they're saying 60% S&P 5, 40% ag bond. They're doing a couple things. They're not doing a couple things. A, they're not tilting to credit. B, they're not trying to really be tactical within their portfolio. And then when you notice C, they don't include things within like international equities or even high yield. So you're looking at aspects when people think about like the death of 60/40 and fixed income, this is it. Well, if fixed income was it, why was cash the best performing asset class in 2023? Why is cash yielding? We're all getting emails and text messages about just personal cash when none of us have had a savings account that's yielded more than 1 or 2%, now yielding 5%. And I think at that point in time, that just tells you with interest rates definitely being higher in the future, inflation, even if it's actually very interesting, the natural rate of inflation is probably not going, it's going to be hard for it to go down to what it historically was. It might be a little bit more elevated than what it has been in the past. But with those two things coming into play, fixed income is still a viable option. It was definitely people are going out there saying that without kind of looking at the numbers and thinking and forecasting out what are some of the things that are happening. Now, there are other issues that come up, but I think that's, those issues all asset classes share.
Yeah, I always felt that, so it makes me feel good to hear you say that.
No problem.
How long does it take to rebalance?
That's for something like this, I would imagine we would give the investment managers 3 days a week, Floyd. I don't know what's a reasonable amount of time to place the trades.
Yeah, we'd give them, we would definitely give them a couple days, 2 to 3 days to raise the cash. That will allow them to be able to have that cash settle. We'd also give notifications to the fixed income managers, hey, you're going to have some cash coming in. So this could be done in the course of 5 business days.
Got it.
And we would, we'd like to, give them that flexibility to seek, best execution along the way.
Correct.
And I don't think we see any, major, flaps in the near term, and they'd be able to navigate that. So.
But let me ask another question. Is there a similar approach being pursued by the city?
So obviously, as Fran alluded to earlier, there's, significant differences between the two funds, not the least of which being the difference in the assumed rate of return as well as the funding level. But I will say the recently approved, just over the last month or two, revised asset allocation at the municipal fund does have a increase to fixed income. So there will be a drop in equities and an increase in fixed income. So in that sense, Don, yeah, there are definitely some. Again, it's not perfect apples to apples, but there's certainly some similarities and common themes between the two plans.
Got it. Now, do we need to take a formal action to move forward with this proposal?
I don't think it hurts if the three of you feel more comfortable. Certainly from time to time, there's some minimal rebalancing or cash raise done, by staff. But given the size of it, in this case, if that makes you feel more comfortable, that's fine. If not, I'll work with PFM to execute over the next, several days.
Yeah, I think, Chris, just from a formal standpoint, I'd like to make the motion to adopt the recommendation of PFM and of yourself to reallocate.
Is there a second?
I'll second.
All right. A motion has been made and properly seconded. All those in favor say aye. Aye.
Aye.
Aye.
Motion has passed. Thank you, Fran.
Thanks, Don.
All right.
Do we, is there anything else, Christopher, that we need to cover under new business?
No, I mean, the next meeting is scheduled for the 17th of January, 2024. I will come back at some point, probably intra-meeting, but certainly by the next meeting, following up on the discussion around one or more additional fixed income options. My initial instinct is that an RFP for at least an index fund makes sense, but I want to, think about that a little bit more on the bond side. And I'll certainly come back with some recommendations, intra-meeting or some thoughts, and then, have it as a discussion item for January.
Don, if I may, Bill, are you still here? Bill
I
Rubin?
am. Yep.
Don, it's possible that Bill may not be administering these meetings going forward. I'm not sure. But if that's the case, Bill, I want to thank you for all the work you've done on these meetings, and really appreciate your assistance and putting the time in.
My
Ditto.
pleasure. Thanks. Thanks,
Ditto.
guys. I appreciate that. My pleasure.
Thanks, Bill.
Absolutely.
Thank
Thanks,
you.
Bill.
Thanks, Bill.
Christopher, there's one other thing I think we ought to discuss, and that is we have not really reviewed our minority participation in some time. But maybe at our next meeting, we might want to take a look at it and make certain that we're not moving backwards, but we are more or less in compliance with where we thought we would be.
Yeah,
Is that
I'm,
fair?
no, I have, among several things on my to-do list is an update on the brokerage numbers, Don. I have gotten the third quarter numbers from the managers. I don't know if I'll have fourth quarter in time for the January 17th. But I will put together that report and get it out to you folks in advance of the next meeting. So thanks for the nudge and for putting that on the record. But that is on my to-do list.
Excellent, excellent. Well, if there's no additional business, is there a motion to adjourn?
Sure, I'll make a motion to adjourn.
So move. Enjoy.
Thanks,
Happy
everyone.
holidays.
Have a
Thanks.
great day.
Thank
care.
you.
Take care,
Happy
guys.
holidays.
Bye-bye.
Happy
Thanks,
holidays.
everybody.
Take care.
Thanks, Billy.
You got it. Take care, guys.
All right.
Will there be any transcript orders needed for today?
There is. It goes back to Chris Diffusco, if that would be okay.
Sure, no problem.
Thank you very much.
Thank you.
Have a great holiday.
You too. Thank you. Bye-bye.
You're welcome. Bye-bye.